Imagine inheriting a substantial nest egg from a loved one, only to discover that without quick action by year-end, you could be slapped with unexpected IRS penalties. Now that's the gripping reality of the 2025 shifts in inherited IRAs that every beneficiary needs to grasp. If you've come into an individual retirement account through inheritance, a major update kicks in for 2025. This change means that, unless you take proactive steps before the calendar flips, you might trigger an IRS penalty, potentially costing you dearly on any missed requirements. Beginning in 2025, specific non-spouse heirs, like grown-up children, will be obligated to begin pulling out required minimum distributions, or RMDs for short, all while draining the entire inherited IRA within a decade. This is based on fresh IRS guidelines unveiled in 2024, which aim to bring clarity to how these accounts are handled after someone passes away. This adjustment arrives just as we're gearing up for what's been dubbed the Great Wealth Transfer, where over $100 trillion is projected to pass to heirs by 2048, per a December analysis from Cerulli Associates. A big chunk of that fortune will shift from parents to adult kids, making savvy tax strategies crucial, as financial pros emphasize. Some beneficiaries might even want to tap into their accounts faster than the IRS mandates, tailored to their personal tax scenarios, according to experts. Let's dive into the essentials of this 2025 change and strategies to sidestep those IRS penalties. But here's where it gets controversial. Should the IRS really enforce such strict timelines on inherited wealth, potentially forcing people into higher tax brackets sooner than they'd like? Who needs to start taking RMDs in 2025? Ever since 2020, certain inherited accounts have been governed by the 10-year rule. This rule requires heirs to completely empty the account's balance by the end of the 10th year following the original owner's passing. The 10-year rule, paired with the new RMD mandate, impacts the majority of non-spouse beneficiaries, such as adult children, especially if the IRA's original holder had already hit the age for RMDs before their death. Many of my clients are navigating this 10-year timeframe, noted Kristen McKenna, a certified financial planner and president of Darrow Wealth Management in Needham, Massachusetts. We've dealt with a lot of uncertainty around RMDs over the years. Prior to the IRS's guidance last year, it wasn't crystal clear if annual withdrawals were needed during that 10-year period. Consequently, the IRS offered penalty waivers for several years on overlooked RMDs from inherited IRAs. But come 2025, targeted heirs must kick off yearly RMDs or risk a 25% penalty on the sum they should have pulled out. And this is the part most people miss. You can sometimes slash that to just 10% by correcting the withdrawal within 2 years and submitting Form 5329. In certain situations, the IRS might even forgive the penalty altogether. A good number of my clients have managed to get that excise tax excused. Denise Appleby, CEO of Appleby Retirement Consulting and an IRA specialist, shared with CNBC. They achieve this by making the right RMD, completing the form, and offering a solid justification. Master the income tax bracket game. Even if RMDs aren't mandatory for your inherited IRA this year, the vast majority of heirs still have to clear out the account within those 10 years. This often calls for careful planning to dodge a massive tax bill in that final year, financial advisors warn. For instance, you could engage in what's called playing the income tax bracket game. This involves withdrawing funds earlier during periods when your overall income is lower, explained Marianella Collado, CFP and CEO of Tobias Financial Advisors in Plantation, Florida, who's also part of CNBC's Financial Advisor Council. During times of reduced earnings, you might have opportunities to utilize lower tax brackets more effectively, Collado added, highlighting her background as a certified public accountant. That said, it's vital to weigh the broader impacts of bumping up your income, like the potential loss of tax benefits from recent legislation, such as the changes introduced through President Donald Trump's Big Beautiful Bill. As McKenna from Darrow Wealth Management pointed out, there are countless factors to juggle when deciding the timing of inherited IRA withdrawals. It demands a deep, reflective review. Now, let's stir the pot a bit. What if this rule inadvertently punishes heirs who aren't ready to part with their inheritance so quickly? Do you think the IRS should allow more flexibility for personal circumstances, or is strict enforcement the only way to keep the system fair? Share your thoughts in the comments. Do you agree with these new rules, or do you see them as overly burdensome? We'd love to hear your take, as this could spark a lively debate on inheritance and taxation.